Good morning, this is Mayor Valensky with Driving Markets. Hope you're all well. Okay, so the overnight futures, the Asian markets are slightly up based on the fact that there's potential peace talks between Russia and Ukraine. I don't think anything's going to happen there personally, but it looks like there could be some developments. Who knows? Also, Zelensky warned that if missiles fall on Warsaw or fall on the NATO-pact countries, then obviously NATO will have to get involved. So that's the geopolitical background. Based on that, the price of commodities will continue to rise. I don't think there's going to be a stop or a fall in the commodities. There might be a short-term downturn if there is peace, but I think you'll probably have a medium to longer-term rise in the price of soft commodities and oils and metals. Going forward, you've got the FOMC, the Federal Open Market Committee meeting, starting tomorrow, finishing on Wednesday. And Jerome Powell said early in the month, before the invasion of Ukraine, that he will support a 25 basis point increase in interest rates. Be aware that interest rates in the States have not risen for some time. So this is one of the first interest rates rises in many years. What was the start? What is the cause? You've got to look at of where we're at the moment regarding inflation, where the cause is Corona. Before Corona, there was no issues of supply and there were no issues of demand. So the economies were running quite healthily and interest rates probably would have stayed at an all-time low for several years to come. However, what the governments and the central banks were afraid of at the time, which they knew eventually would come out, is that there is a supply-driven inflation link where we're at the moment with the economies. So Corona was the starting point of where we're at today with inflation. Remember that when Corona started, all the central banks and the governments were so afraid of an economic downturn that they pumped hundreds of millions and billions into the global economies, and that gave a lot of liquidity to regular families, a lot of money to regular families, which is liquidity, which normally didn't have this type of money. We're talking about in the States, where an average family would get around about a $10,000 one-off payment. Some of the families never had that money before, and therefore they went out and they spent it. However, the Corona effect was there was lockdowns and shutdowns, and the factories were constantly being shut down based on a Corona pandemic spread or a new variant coming out, and that disrupted supply. As a result, the lack of supply and the high demand has pushed up prices across the board, excluding the Russian-Ukrainian crisis. Now, taking the Russian-Ukrainian crisis into account, then what you've got is aggravated price rises across the board on oils and grains, and you've got a supply-driven inflation link. Put that all together and you're going to have an economic downturn. For example, sales in January or sales in February are expected to drop to 0.4%, but down from 3.3%. That is a massive drop, and that is indicating that the consumer is simply not going to pay the prices that are being demanded for in the shops at the moment. Consumer price index was at a 40-year high last week, and so consumer confidence is at a 10-year low, the lowest since 2011. So that is you've got all these factors of rising inflation, low consumer confidence, and you're going to have an effect on sales and a potential downturn in the economy. Also, you've got the producer price index coming out tomorrow, which is likely to exceed 10%. Now, I am saying that the producer price index is already in excess of 10%, and consumer price index, the inflation is already well above the 6, 7, 8% that's being quoted in Europe and in the US. So you have to look at where are the markets likely to go forward. The Nasdaq will continue to fall downwards. The trend is down because interest rates are likely to go up much more aggressively than first anticipated. So stocks like Facebook, Tesla, and anything within the Nasdaq will be affected by rising interest rates. Cryptocurrencies were slightly down over the weekend, slightly down at the moment. but wait to see where we're going regarding those digital assets. Another point to look at is China. Russia may look to avoid all the sanctions by doing all transactions via China. However, the States has clearly stated and mentioned that if China helps Russia break those sanctions, then there will be sanctions on China. What effect will that have on inflation? What effect will that have on supply? So you've got a lot of factors coming in that will aggravate and will produce a much more intense response from the US governments if Russia breaks those sanctions, and will have an adverse effect on inflation and interest rates if America was to sanction China. So you've got two major economies potentially that could be sanctioned, Russia and China. That would send inflation super high, well into the 20-30%, and interest rates would be going to the 6, 7, 8% range if that was to happen, just to let you know. So look out for the FOMC meeting on Tuesday and Wednesday. As regards FX currencies, you're going to have a rising dollar if rates go up, so the dollar will gain strength. I do believe that the pound is a good currency to get involved in, so if you're looking to trade, I would suggest you go long of GBP, British pound, definitely against the euro and maybe against the dollar. But the pound looks like it will strengthen over the next few months. So that's to do with FX, and whoever's trading on FX, be aware and take a note of where the pound is at. If you need to get hold of me, contact me on LinkedIn, on WhatsApp, on Instagram. Anything said in this piece is an opinion only, of course. This is Meir Walensky with Driving Markets. Have a good day.